Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, February 26, 2016. This week, the stocks came basically at the first resistance level. They rallied there. Now, the market breadth indicators are recovering, but we'll see if this is enough to turn the long-term picture bullish for the stocks. Bonds may be retesting their breakout, but are still trading near all-time highs. We'll look at the dollar, which held support, and as euro actually fell against the dollar. We'll look in details at gold miners, and also we'll look at silver and see if it is leading, about to lead the gold lower. We'll also look at gold, which is showing signs of life, and natural gas, which may be ready for a set of fresh multi-year lows again. Okay, this is a chart of SPY, S&P 500 ETF, kind of like a proxy for the market. So we bottomed out here at 52-week lows on the actual chart of S&P 500 without the dividends, because S&P 500 ETF includes the dividends. We did hit a 2-year low, and I'll show it in the next chart. Then we rallied pretty hard from the possible support here. Now there are several unfilled gaps here. There's a gap right there that's unfilled, so it's possible we'll just collapse from here, because we're already at the resistance level, and the resistance level is defined by a breakdown below this previous support, and there's a little gap there as well, a very tiny one. Anyway, so looks like the Friday's action is already kind of indicative of a possible resistance, because stocks gapped up in the morning but then basically sold off throughout the day. But alternative scenario, of course, is we maybe find support around the 50-day moving average and then continue higher. Now up here in 203, 204 area, there is some strong resistance for several reasons. One is this declining 200-day moving average in green dotted line here. The two, of course, is this big gap down from the beginning of the year, from first day of trading in the year. Now this gap will eventually get filled. I don't know if it will get filled on this rally, or it could get filled 5 years later when this bear market is over. Again, I still think that we are in a bear market. S&P 500 is in a bear market, and I'm basically reversing my psychology for finding opportunities within the bigger uptrend to buy, to finding opportunities within the bigger downtrend to short. Now, if we do clear this area, which is a big if, we could run up to all-time highs, which are actually back there. But it's around the 210 area for us, for SPY. So of course, if we still presume that we're in a bear market, then this would act as a major resistance, and somehow I doubt we'll even get there. I think we'll fail around this area, but in the stock market, pretty much anything is possible, so we'll keep an open mind. Now, next several charts, I'll show that my long-term outlook for the market has not yet changed, and I still think we're in a bear market. So let's go to the longer term charts. All right, this is actual underlying index, the S&P 500. So this is a 2-year low right here, because without the dividends we made a 2-year low. Now, pretty much ask anybody in the trading community, and you will get pretty much the same answer, that 52-week lows, multi-year lows are quite bearish. So we are rebounding from the levels here, and just like S&P 500, it looks like there is resistance here from this previous peak, and maybe we are already above that resistance. So there's a possibility that this resistance level has already been broken, and we may continue higher to the 200-day exponential moving average. Long term, again, I don't think we changed much. So down below here, I have several of the market breadth indicators. For example, S&P 500 percentage of stocks above the 200-day exponential moving average. We're still in a very low, in a very low territory of only 42% of stocks being there. But you can see that actually this is a first time we see a reading above 40% this year. So that's already quite an achievement for the stock market. Now we were quite, well, not quite, but somewhat oversold. We were at only about 19% of stocks were above their 200-day moving average. And so we did rally. Also, the bullish percent index is also a longer term indicator. You can see it dipped into the below 40 below 40% territory, and now is attempting to rally to the plus 60. So these are all positive signs. But I think that generally speaking, we're already overbought. You can see that percentage of stocks above the 50-day is already around 60%. Percentage of stocks above the 20-day is already around 80%. So this could be already like a setup to go short. But we'll, keep an open mind. So next couple of charts, I'll show my custom market breadth index that has a predictive value of about 90% going back to 1970s. Okay, again, this is S&P 500 going back to the 1996. It's just a little bit easier to visualize than the previous chart. So similar thing here, I have a 50-day moving average and a 200-day moving average, and I removed the price. And if you just notice that this is already a pretty decent way to identify trends, is that if the 50-day is above the 200-day, we're going to assume that we're in a bull market. And vice versa, when 50 days below the 200-day, we're going to assume that we're in a bear market. But then you can see those pink boxes here. Those are false trend changes. And during those false trend changes, we can say that even though the 50-day went below the 200-day, the major primary trend still really remained. For example, here in 2010 and 2011, the trend did not change and the stocks continued to rally. What I like about market breadth index is that it is a very clear indicator, and it calls those entries into bull and bear markets very clearly, and most importantly, it identifies conditions as whipsaws, so that you don't get stopped out for no good reason, really. Now, down below here we have one of the inputs, and the market breadth index has actually quite a bit of inputs into it, so it's a pretty robust model. But one of the indicators down below here is one of the inputs for the market breadth index is the raw MBI. I call it one of the inputs for the MBI. Now, you can also look at it and say, okay, occasionally this input gets oversold. And for example, here in 2003 and in 2002, 2003 and 2008, 2009, this indicator was truly oversold. It was really, below 20. So at that point, we can say, it's a little bit too oversold, and we can start looking potentially for an entry on the long side. So it's kind of like a opposite indicator. Now, currently, we're not yet oversold. We bottomed out in the beginning of 2016 at around 28. 28.57, and since then rallied to 42. So I did not see a strongly oversold reading to say that we have certainly ended a bear market. I think that we're still going to continue. We probably will rebound and then take another leg down. So for now, again, I'm keeping a bearish bias on stocks, and there's also, I put in here a Fibonacci retracements, and this is from the bottom here in the 2009, from 666 to the top here in 2015 at around 2100 or so. So a normal pullback. Let's just pretend for a second that this is not a daily chart going back to 1997, but let's pretend for a second that this is a 5-minute intraday chart. And traders notice that this breakout always gets retested. Well, sometimes it doesn't get retested, but eventually it will get retested. So this correction area here is a kind of like a normal retracement, really. If a pullback does occur, we can easily see a correction to around 1500, possibly even lower to 1400, and a very deep correction would take the level S&P 500 to around 1200. Now, at that point, we actually could completely collapse and make a low again. Anyway, so just something to keep in mind that a normal retracement could take us all the way back to around 1500 or lower. All right, let's switch gears a little bit, and this is a TLT, the 20 plus year Treasury bond fund. So we had a breakout here in the beginning of February, and this is actually we had another breakout here in January as well, and then we had a breakout and a run to all-time highs. Now, it's normal to pull back from all-time highs and to retest this breakout. So it looks like we did get somewhat of a retest of this breakout, but maybe we'll get another one. Like for example, here on Friday, we had a pretty sizable gap down, and this gap actually held throughout the day and was not filled. So this shows that maybe bond bulls are kind of getting a little bit exhausted after all this buying here. And maybe we'll get a pullback to the breakout level here, or possibly even a deeper one to the breakout level here. Now, once again, long term, I think bonds are in a bull market, so I think a pullback to maybe 126 or even lower would, in my book, would be considered a buying opportunity, really. All right, let's move on to AGG, which is a aggregate bond fund. Okay, this is AGG, aggregate bond fund, kind of like a proxy for the entire bond market in the United States. This is a long-term weekly chart going back to 2014. So, we had a nice breakout above the previous highs here in 2015, and these are all-time highs. And the good thing about this is that we have these three bullish candles, hollow black candles here trading above the previous breakout level. So that's certainly a very good sign. Now this whole pattern here potentially may look like a cup and handle or some sort of weird, cup. And the depth of the pattern here is 3.3%. So we got a breakout here, so it's not uncommon to see a run, this entire depth of the pattern to be duplicated on the upside. So this would take the AGG somewhere around 112, 113 area. Now, should this happen, most likely stocks would come under severe selling pressure. So this is, bonds are clearly a hedge against, hedge when the stock market is in a fearful mode. The normal response for investors is a flight to safety, and bonds are, especially the government ones in the United States, are the ultimate safety, safe haven. So, I would not be surprised to see a run up in bond prices, especially if stocks come under further selling pressure. All right, let's switch gears again. This is United States Dollar Index Fund. This is a daily chart going back 11 months. So we had a pretty sizable drop, in beginning of February and continuation lower, but I was saying all along that this could be a nice buying opportunity, and we did find support around here 95 level, and then we had this gap up, and usually gap ups means that it's a strong buying pressure, and then we continued higher. Actually, this week we closed above the 50-day moving average, so these are all positive signs for the dollar index. Next chart, I'll show the euro versus US dollar. Had a pretty nasty couple of weeks here and just continuously sold off. Now, there was probably a lot of excitement here in the community about this potential breakout, but it clearly failed so far. I think euro long term is in a downtrend, so it does make sense that we're we're probably gonna re-challenge this lows here at what 105. Next, I'll show the US dollar weekly chart, and this is an interesting pattern here. Looks like we had a breakout in 2014, and then around to 52-week highs here, and an attempted around to 52-week highs here again at the end of 2016, and then since we came back. Now, if we do run up here again to 100 area and then break out, this could be a possible cup and handle pattern. And then if we break out there above it, then we'll need to do a measured move target, which is a depth of this cup here, and this whole thing, which is around 9%, could be duplicated on the upside. And this is a basically, if the dollar rallies another 9% or so, this will certainly weigh on various commodities even further. And the most obvious commodity that comes to mind is, of course, gold. So let's continue to gold next. Okay, so this is gold daily chart spot price going back 6 months. We had the multi-year lows here, and then we had what potentially was a cup and handle. We had a breakout above the lip of the cup, and they run higher. Notice that the target was exceeded. I said 6.2%, the depth of a cup here, and the target was actually exceeded. And we have a potential breakout above these highs here. Now again, I keep saying potential, and next several charts I'll show why I keep saying that, but long term I think gold is in a bear market. And looks like we have already several rejection candles here. Actually, we have 1, 2, 3, 4 potential rejection candles just in the last couple of weeks. Anyways, a normal retreat. Let's just for a second say that we did enter a bull market. Usually securities come back and retest breakout. So at the very least, we could see a retest in the 1190 area. And if should that not hold, we could continue lower. Okay, let's look at the more longer term chart now. Okay, now again, this is same as I just mentioned about my market breadth index. Same thing here. I was not very satisfied with just a basic, trading of 50 day above the 200-day moving average. We go long, and vice versa. It's 50 days below 200. We could go short. There are multiple instances of whipsaws. This is a gold chart going back to 1984, and here I counted all of these whipsaws, and I think there was about 30 of them or so. So there was a lot of trend changes. So if it followed this simple system of 50-day above the 200, you would have been wiped out many times over. Now, what I did is I pulled a lot of just various data about gold and gold miners, and I created a custom market breadth index for gold. The best so far I was able to come up is the market breadth index, gold breadth index, which eliminated vast majority of the whipsaws, and it was able to call most of the markets, bull and bear market since 1985. So we had a 9 out of 12 success rate, which is 75%. So some of those signals were not good, obviously, because there were even with this market breadth things, there were several whipsaws. Now the good thing is that it was able to eliminate quite a bit of the just the regular whipsaws here. Now, one of the inputs for the gold breadth index is this here below, which is a gold miners in an uptrend. Again, also a experimental and private raw data. But based on this simple indicator, I was able to see that we need to see a move above this 70 line for the market to turn bullish, for the gold market to turn bullish. Now, as of the writing of this post, so far I have not seen this turn bullish just yet. So If it does turn bullish, I will say that yes, we have entered a new bull market in gold, and I will start looking for bullish opportunities, for long opportunities. But as of right now, I don't think we're there just yet. Okay, very briefly, this is gold weekly chart showing each one of the sticks is 1 week's worth of activity, and this is showing the recent possible breakout to, let me see, where is it? To here 1263 from the bottom at 1045 to 1263. Now I put in the Fibonacci retracement lines, and a normal pullback, a shallow pullback, would take it, if this is even a correct, true breakout, will take it to around 1180. A more deeper one will take gold back to 1154, and a pretty decent deep pullback would take it to 1128. Anything below that could potentially mean that we're going to collapse back down to all-time multi-year lows, rather. Here's an interesting thing. This is silver. This is also spot price daily chart. Very interesting. It looks like we had a big drop, 3% drop here on Friday, whereas gold held more or less held up here, in its own territory. The silver really just could not hold its own and collapsed below this low here. Now, next chart I'll show a correlation between gold and silver, and they're extremely close. So I'm wondering if silver is now leading gold lower, or will lead gold lower. Okay, this is silver spot price weekly chart going back to 2011. Basically, this chart shows that I have a correlation coefficient between silver and gold, and you can see they are extremely well correlated. So if one goes up, the other one goes up, and when one goes down, the other one goes down. Correlation coefficient of 78%, and it's basically for all practical purposes very closely correlated. If a correlation coefficient is above 50%, I consider it highly correlated, but this is 78%. So it's kind of like saying almost like QQQ and S&P 500, they're extremely well correlated. So what I'm trying to say is we had a potential breakout in silver again, as with gold, and now looks like silver is already, it looks like it might be ready to challenge multi-year lows again. So I wonder if silver is actually going to lead the prices of gold lower, or maybe silver will turn around. We'll see. But in any case, as of right now, I'm treating both silver and gold still to be in a bear market. Okay, this is GDX, gold market, gold miners ETF. Same thing as gold, really. It's just more volatile. This move here is about 50% move from bottom to top. Now this big candle here, it looks sort of like a rejection candle. It's very large and it has a black filled body, so that means the price gapped up, possibly spiked during the day and then continued lower. It didn't close below. Ideally, it would have closed below here, around here. Then I would say it's definitely like a shooting star candlestick. But this looks more like kind of like indecision, sort of. But then Friday's action, looks like we had a close below the low of this level, below the low of this candlestick. So maybe this is already an indication that we're going to get a retest of this breakout above the 1680. Again, the same. It all really depends on gold, and if gold decides to take a dive together with silver, then gold miners will surely follow. Down below here we have gold miners market breadth index indicators. For now they are confirming this breakout, but again, and actually this is interesting, we have finally seen some significant number of new highs being set, which is if you're a gold bull, then that's certainly a welcome sign. Now again, a normal retracement would take gold GDX somewhere around 16, possibly even $15. Anything below that most likely will collapse and attempt to go to new all-time lows. All right, this is WTIC light crude oil spot price daily chart. So pretty powerful rally here off the lows in February, and we're finally able to close above the 50-day moving average, a steeply declining 50-day moving average. Now we're basically at resistance here at 34 and change. Today we came up to a little bit over 34 and a half. So we're basically already at resistance, and resistance can be defined by this broken support, by this big candle. This support was broken here at 34.50, so it's already pretty good resistance level here. Now, if we do punch through this resistance, maybe we gap up on Monday or something like this, we could continue higher to next resistance level, which is defined by this peak from the 2016, from the first trading day of 2016, and this broken support here as well. So there's some pretty stiff resistance here, I think. Next resistance level, of course, is this 200-day moving average around $44. And then finally, if it even makes that high, I don't think oil will go anywhere around more than $50, barring complete collapse of oil market somehow. Anyway, so bearish security, we were able to lock in some nice gains here, so consider signing up for my trade alert services. Anyways, nothing terribly to get excited about except for potential short setup. Anyway, so that's all for oil. Okay, and let's wrap up with natural gas. One of the more volatile securities out there, natural gas. So you gotta really have a good nerves and good stomach to for this kind of volatility. Look at this, it's almost vertical rally here, and this is a short covering rally off the multi-year lows. Pretty stiff resistance here, pretty clear too. It can be defined by this peak here. Rejection at resistance, fell down. We had a rising wedge. I pointed it out. We had a rising wedge break, and then a little bit more bouncing around, and then finally we're re-challenging multi-year lows again. So on Friday we're actually at the lows. Potential, maybe this is a doji hammer candlestick, but this is a bearish security, so this support is really it's not meant to hold. In a downtrending security, we can broken supports are normal. It's the broken resistance that we should be worried about if we're trying to short. So this resistance here was not able to hold, and that was a normal sign of a failure. While here at the bottom, if we do hold it here, that doesn't mean that we're going to hold it in the future. We may bounce up and then continue down again. Anyways, that's it for this week's recap. Thanks for watching, and please stay tuned to see how to find us on the internet. Have a great day. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet, and there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out. for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube stacked with accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye-bye.